All right. So we're recording. You can just go ahead. What if you have anything planned on how you want to get into it?
I think I'll just start with the basics
Like it.
on just some statistical concepts. Um, so I'm sure pretty much I hope everyone here knows about like the mean median mode that we all learnt in school. Um, so the mean is basically the key function for how standard deviation is calculated, and essentially the mean is just a bunch of averages or a bunch of plots summed together divided by the number of instances. Um, so if we had a bunch of numbers, say 5, 8, whatever, 3, I'm just randomly putting in these numbers, then you add them all up and divide them by the number that there is, we would probably get something like 7.2 or something in this instance. And then you obviously have your outlier as being 3 and an outlier as being 9. Um, so then if we look on um, if we were to if we were to graph that, you'd basically have all of these instances. So if this was the average height here through the middle, being let's say that the average height is 7, so this would be the the mean along the equilibrium of this box. So let's put here that this is like for intents and purposes, we'll just say that it's 5 on a range of 1 to 10. Um, and then throughout here we get random distributions of numbers um, for different whatever they might be. Um, Depends on what asset you're looking at, whether you're looking at like the heights of people or whatever it might be, and you then plot that around um, the mean, right? So then, if we know what the mean is, which is the average of the sums, the standard deviation is the distribution of the. Hold on, let me get this definition right. I had to look it up because I fucking forgot what it was. It measures the variation or dispersion in price. So when I looked it up last night to see what other people define it as, they use it in trading mostly for volatility purposes, which is essentially what we use it for. Like, let's say that this is the CBDR and you see price bouncing around like this, and then you get like this manipulation leg where it's like this, comes back in the range and then takes off. You're taking it off the manipulation leg. I've tried to find out why we take the standard deviation off the manipulation leg. I think it's just because we have an extreme outlier that um, maybe skews the data from the from the range, and maybe that creates like some sort of anchor point or something. But there's no evidence or anyone talking about exactly why it does it. Um, so yeah, I'm still trying to find that out. I've
I think
also looked at
I think it's the same as like when we're pulling it in a price leg and it's the stop hunt. It's kind of the same, you know. If it's the CPDR or it's the normal price swings, right?
yeah. Um,
Same idea.
so basically, let me just try and articulate myself. the best I can here. So let's say that again we have the distribution curve, right? You guys may have seen something like this before, which is just a standard bell curve, and then you have the mean right up through the guts, or it might be skewed to one side. So let's say that it is the heights of teenagers in, I don't know, high school or something, right? If you're going to go into Asia, let's say that the heights here, like the mean is like 160 or some shit, right? But that 160 might be here, compared to like heights of teenagers in other countries, because Asians are shorter on average. And then if you went to like Netherlands, this the distribution would be over here, right? And then all we're doing is with the with these distribution bell curves, you've probably you actually have seen these if you've seen volume profiles, because this is exactly what a volume profile looks like, right? So if we go back to the chart and we have a look at this price action here in the blue box, bear with me here. This is a bell curve. This distribution is basically all the individual plots of buys and sells plotted into the volume profile. So we know that we have the high volume node with the most amount of trades settled, and then we have the two high and low of that volume profile, right? So this is essentially a distribution bell curve. Now, what can we see from this information? If we come back over here and we look at it again this way, where it's like this, well, we have our volume node, and you can see that that high volume node is shifted off to the right a bit, and now you can see that it's shifting back to the left, and it keeps adjusting because I've got it on the extend right. Now, what we're looking at here is you're going to have standard deviation. So if you have a look at like a plot, right, on a bell curve, your standard deviations, which is basically sigma 1, sigma 2, sigma 3, you'll actually see that so sigma 1, which is one standard deviation, is basically the average distribution one standard deviation away from the mean. And between this is the key point that I was trying to get to, is between one standard deviation on either side of the mean. So these aren't the standard deviations, by the way. Okay, these are just the volume nodes for a high and low. So we don't know where the actual standard deviations sit, but it works the same way. If we know that this is the highest volume node, therefore it's going to be the most number of trades within this distribution curve, the mean is probably going to sit within this area, right? Because yes, you've got an outlier here, up here. Oh shit, magnet's back on. You got an outlier there, you've got an outlier there, you got an outlier there, you got an outlier there, you've got an outlier here. Okay, but all of our volume is sitting in this range. So what we can take away from it is that we know that the mean is within this high volume area. Now, one standard deviation is within 68%. You might know that number. from somewhere, 68% or 0.68, 0.68 rather. So 68% of the data sits within one standard deviation of the mean. Okay. Then if we go to 2 standard deviations, so sigma 2, 95% of the data plotted or scattered sits within 2 standard deviations. I hope you can see where I'm going with this. 0.95. Right? So 95% of all of the trading range data from the mean, 95% of that data or trades are happening within 2 standard deviations. Then if we go out to 3 standard deviations, you have 99% of the data happening within that 3 standard deviation range. So now the question is, if we know that at 2 standard deviations, 95% of the data should be happening here, what do we think this becomes? Right? Oh, I've done it again. So here, 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 here. These are all the outliers, right? And if there was a way to plot our standard deviations like this, right? So whether we take it from like the high volume node to the mean or whatever it might be, or we do it like this, where we go like, done that the wrong way. Can't actually pull it. You can't pull it sideways, obviously.
You would have to take the fib box instead.
Yeah, fuck that.
Fuck that. Oh, good.
But the point being that most of the data is going to happen within this range, right? So if you think that price is doing this, and then we get this spike up to 2.5 deviation, what do we expect to happen? Come back and have a mean reversion. And then all we see here is basically an AMD setup where we have accumulation, manipulation, distribution, and then a mean reversion. But obviously we know that price is moving all the time. So how is price moving away from the mean? So what's happening is it's just your normal supply and demand, right? If we have, just want to see what's happening. Okay. Let's say that the only asset in the world is apples. And apples turn over $8 trillion a week in sales. Everyone buys apples, everyone sells apples. Well, we would have a very stable, fluid, efficient market for apples, right? So let's say that fair value price for apples is $1. So we would have apples at $1, and price would basically be like this the whole time, like almost a line. But then one day there's, half the crops are wiped out or something. Well, we know that all of a sudden we're going to have a repricing for apples because we have less supply and more demand. Or let's say that a new market is introduced where we have bananas coming. All of a sudden, people are buying less apples and price shoots down, right? So, what was the analogy I gave you, Matty? Do you remember? I'm trying to think of.
It was it's the Ferrari analogy. It's the
Yeah,
same.
I guess it's more. Now we're just talking about supply and demand, right? So, and you see it in market maker models all the time, where you have we know that. Sorry, I'm jumping all over the place a bit, but we know that price does those two things where it's either seeking fair value, where it'll find some sort of like PD array or imbalance, and it starts off like this, right? And it's just consolidating because you've got buyers and sellers matching pairing orders within this range. So you can call this a CBDR, you can call this Asia, you can call this whatever you want. And the reason we see Asia, I mean, it's actually a very good example. The reason we see Asia consolidate a lot of the time for EU and GU is because it's an asset that the Asian market is not interested in. So they're not participating. And any orders that are participating are basically getting paired within that overnight period, until the algorithms, market makers, big entities come online, and then they start, you know, pushing price or executing the orders in the direction they they want their hedging program to go in, right? So if we know that this is our main distribution, this is our bell curve. So we would have something like this where it would be like this, right? That doesn't look too appetizing.
Careful what you're
Maybe
drawing, dude.
you can't put this screen. Um, okay, so yeah, we have this bell curve, right, where it's like this, and then we get this like manipulation up here, and then the distribution. We know that this is accumulation, manipulation, distribution, standard power of three setup, and we know to draw it off the leg, the manipulation leg, swing high, swing low, whatever it is, right? So then you've got your 0.5 to 1 standard deviation. Now, if you think about, people always talk about, whether there's algorithms or whatever. Personally, I think that there's definitely algorithms, but they're not trying to hunt price or do shit like that, right? I'll get into that in a bit. But these algorithms have to have something put into them to be executed. And they're called macros, right? Which is just a macro is just an order that you set, a set of instructions. So for that to happen, they might put in something like take the mean average of the CBDR and then start buying once it falls out of the range, right? So, if you've ever seen any sort of coding, it's if and then statements. So take the CBDR range, if it deviates and then comes back into the range, then buy at X points, right? So it would be telling it to start accumulating, or in this case, distributing, because we're on the sell side of the curve. But then where does it want to start offloading its orders? It would have in the macro to start offloading at 0.5 to 1, right? So that's why we see normally we have this like next range like this. And then you get a break out of the range, and then we see the silver bullet, the expansion between 1 and 2 standard deviation. And then you see this huge distribution curve. And then we are now 2 to 2.5 standard deviations away from the mean. And we know that at sigma 2, which is sigma standard deviation, standard deviations away from the mean, we are now at 5% of the bell curve that distribution is outside of the 2 standard deviations. So therefore, if we know that it's such low probability that price is going to continue past 2 standard deviations, we basically want to offload our position here, which is why we see reversals happen from 2 standard deviations, right? And that's essentially all that's happening. And if we give the Ferrari example, let's say that this is $100,000, right, for Ferraris. $100,000, good price. But then, um, no one wants Ferraris, right? So Ferraris dropped to 90,000, and people start buying them because they're like, "Fuck, it's pretty good." And other people are like, "Wow, it's dropped 10%. I need to fucking I'm just gonna offload at this price." And people start matching orders. There's enough buyers for sellers. But then all of a sudden, people are like, "Nah, fuck it. New Tesla's out. I want to buy the Tesla instead." So then we drop to 80,000. And what happens is we find that we're now so many standard deviations away from fair value that we have a mean reversion back to here. And this is just a supply and demand thing, right? And what's happening is the market makers and the algorithms are not, they're not hunting stops, or they're not doing any of this shit, right? If you think a lot of the entities around the world are not trading forex or gold. That's not what they're in the business of. They're in the business of oil, gas, and I don't mean the charts, the tickers. They're not trading these things, right? Um, what you'll find is they basically employ these third parties who are traders to just hedge against their underlying asset, right? So if they're in, let's say they're in fucking, I don't know, cobalt or something, right? And they their revenue is $5 billion in cobalt a year. Well, they need to hedge against their business, because if Elon Musk goes to fucking Africa and finds a lithium mine, and all of a sudden they uncover a huge deposit of lithium, they're gonna manufacture a whole lot more Teslas, which, or whatever other energy resource cobalt uses, and cobalt all of a sudden becomes obsolete or close to, and your whole business is now down the drain, right? So if you imagine that this is cobalt and lithium, all that's happening is the cobalt company is saying to their trader or their hedger, I need you to place bets against cobalt on lithium so that we are hedged, so that let's say that this does happen, well, even though we're going to lose 5 billion on cobalt, we're going to make 4.5 billion on lithium. And that's essentially what's happening in a market maker model, is you have big money hedging their orders in a buy and sell program, right? And they're just buying and selling and offloading, distributing and accumulating. They're not trying to, these, I don't know exactly where these levels of manipulation come from or what's happening in these instances. I think it might just be basically, um, you have a bunch of orders trying to push price in one direction, but then obviously you have these other institutions that have orders set below highs or below lows, and then they just get involved. It's not like they're thinking, oh, we need to use ICT's PO3 model to run out all these stops. They're simply just putting a macro in to say, if it goes above here, sell. If it goes below here, buy. And that's all they're doing is executing through that way. But this talk was basically based on standard deviation, and the best way to think about it is if you can see where fair value is, all you're looking for is an accumulation, right? Because you know that an accumulation is the majority of orders. The standard deviation is going to be the distribution of the variance of orders away from the mean. So the reason you see such success with 2 to 2.5 standard deviations is because we're so far away from the mean that a lot of the data that's happening now is considered an outlier, and therefore the algorithms want to have been told to execute and offload at this level, right? Because the chances of price continuing down here are close to less than 5% because we're right at the tail end of that distribution curve. And I guess that's the best way I can articulate it at this time.
It's
But
it's it's amazing, dude.
yeah, I don't think I gave the best fucking chat on it, but yeah.
Nah, for sure, because like for a lot of us, it's like
Well,
it's
it's just
just a
numbers, right? It's
Fibonacci.
just numbers.
Yeah, but now we know why it's a Fibonacci, and then we know we can use it with a lot higher conviction.
Yeah, exactly. And that's exactly where the number was coming from. Was when I saw that 68%, I was like, that's a Fibonacci level.
Hmm.
So you can imagine that it's that's why price is always reacting from these levels, is because it's a high probability of the time the data dispersion is going to happen in that area. It doesn't make sense for these anomalies to take place. Um, and yeah, you just look at, I guess you can look at anything in the real world and just be like, oh, fuck, that was random. That shouldn't have happened. Well, yeah, it's probably one instance or whatever it is, right? Um, whereas everything else is happening how you expect it to happen. And then you get that few outliers and you're like, oh, wow. And those are the opportunities you got to capitalize on, because if they're only happening on rare occurrences, then there's a chance that they will go back to the main distribution.
Exactly.
I hope that makes sense. I hope it makes sense for everyone. But
Yeah, look, I wanted to just the
bit
manipulation,
of
like, right, when you have that accumulation, you get that manipulation. It could just be that they are already foreseeing that they wanna buy lower, so they wanna offload their stock just and then so price just goes tiny bit higher, and they're like, well, we're going for lower, so we're offloading what we have, and so they
mm,
are starting to kind of press price down a bit like that. Could be.
I saw something where they were saying that like market maker, like when we were studying ICT 22 model, right? He talked about, and like that Casper guy,
Hmm.
they always talked about like displacement, right? And
Yeah.
what is displacement? Displacement is a footprint of the market makers, right? And it's not entirely true from my understanding. All it is if you look at this like candle in here, right? We know that, I mean, it's inverted. I'll just change it back. But this candle here through this high, right? This is an imbalance, and essentially all this is too many buyers and not enough sellers, right?
Hmm.
So something's happened where we we go below a low, then there's obviously orders being executed where it's like, if it goes below this level, execute. And then you can see that enough buyers are coming in, whether they're market makers or algos or whatever, doesn't really matter. All we know is that there's an imbalance here of buyers and sellers, and therefore we now have this area that should be retested as fair value. Um, reason being is, if the way I think about it is, if we have this imbalance here, let's say that again, let's say that this is like our Ferrari fucking chart or whatever. This is 80,000. Up here's 100,000, and here's the mean at 90,000. If you if you were in the market of trading Ferraris, you'd be pretty switched on to what price is doing, right? It's like it could be fucking you're looking for a gaming laptop, you could be looking for an Xbox, whatever it is. If you're privy to what an asset is worth, you have in your own mind what fair value is, right? So if this is the range that you see that asset fluctuating at, as soon as it fucking goes below here, you're looking to purchase the asset, right? Because you're in the business of trading that asset. So you execute here, but then everyone's also fucking buying, and then we're back above the mean. So you would expect that price would want to come back and retest this area of imbalance. Was there actually enough buyers to support this level, or was this just FOMO? Was this just a one-off, you know, bit of hype? Oh fuck, Ferraris are so cheap now. But hold on, these are 2011 Ferraris. They're fucking shit. No one actually wants them. Everyone just saw them for what they believed was a good price. And what happens is we fail to offer fair value here, and then we drop because the fair value gap, which is what we know it as, has offered fair value, but that fair value has failed. And again, if we just look at this as a range, right, what we'll see is exactly this blue box, but in this red box. So then if we, and this is why I just look at all of these PD arrays as ranges, is if we see fair value doing this in this range, you'll see that it might deviate with a wick here, but then it comes back in the range, and then it goes to EQ, and then it's around at EQ, fails, might come back to range low, finds buyers, comes back, reclaims, tries to break out, fails, right? And again, this is just a market maker model, right? It fails to break out of it here, doesn't want above 90k for Ferraris anymore. The market's decided, nah, they're depreciating. That's not what they're worth anymore. And it reprices to a new level. Okay, we come back down, we're at 82k, and that's where fair value is now. And this is all that's happening in the markets constantly. And because you have an asset that turns over fucking trillions of dollars a week, you're going to have extremely efficient price action, right? There's enough buyers and sellers. If you wanted to go and sell, I don't know, let's say that you have a fucking odd sock, the chances of you finding someone for that odd sock are impossible. No one's going to buy it. Maybe a homeless guy, right? That's the only person that's going to buy an odd sock off you, and he doesn't have any money in him. So this is why we have like awesome price action, is because these are super efficient markets. Yeah, they might be choppy or whatever, but they're not they're not random. They respect levels. They do, they have order flow. Whereas if you go to like some fucking shitcoin with zero liquidity, you see like, okay, it's just entered the market, does this, and then there's an injection because they're fucking scammers, and they know that if they pump it, people will come in. But it's also hit two and a half standard deviations up here. So it has a little pullback, and then another injection, and people are seeing it, and then you get the fucking FOMO blow off top, and then bang, rugged, right? And then what happens? Nothing ever again, because there's no volatility, there's no use, there's no need for that asset. So I think like the um, the main things that people need to think about is not arguing over whether there's fucking algorithms or whatever. All you need to know is that price is efficient because there's enough buyers and sellers. All that's happening is orders are being executed, and the way that they're being executed is not by you and I sitting behind our terminal. There's people aren't doing that with $100 billion. All they're doing is typing in a macro saying if price hits here, execute at 2.5 standard deviations, right? The reason they're using that is because it is a statistical term, it is a statistical function, and it's a high probability function based on data, and therefore all they're trying to do is minimize their loss. They're not actually, most likely they're not trying to make money. They're just trying to, as I said before, hedge against whatever their underlying asset is and reduce their risk, because that's what they are. They're risk managers, right? And you see that cliche fucking thing where people are like, "Oh, we're not traders, we're risk managers." Well, that's essentially what these other professionals are. Is that they are risk managers. They have an underlying asset and they are just trying to offset that risk. And that's essentially what is driving price action. Is just it's an ultimate hedging program. Thank you for coming to my TED talk.
That's banging, dude. I hope that when there's a lot of light bulbs off in your guys' head as mine. It's like why would like ICT is cool and all, but why would you trade it when without volume? When you just had Baxter just showing you that volume is everything. You can use it in the FIB or you can use it in the fixed range volume profile, but it's essentially all volume. So it's like a great insight in how price is delivered. It's not just standard deviations. You just learned about order flow and how price is delivered from one high to another. It's
Yeah,
like
exactly.
it's literally this is literally the market that he just explained in 30 minutes. And if you can kind of figure out a way for you to just see that, you can go really, really far. And I thought, if it's all right with you, I just take over and show a couple of examples on the chart of like how you can get it like that.
Go for it, mate.
All right, let me just share my screen here. Go live. All right, just a quick way of seeing it, just to make sure that everybody's on the same page. So here we have the Nasdaq, and I already drew out a lot of them, but let's just for the fun of it take um, yesterday's CBDR range, which we would draw from the high of the body to the high here to the low of the body right there. You see, kind of we already so overextended. Is that the Monday? Yeah. Wait, this is the Monday. My bad. I wanted to show this one, kind of cherry pick, but I can show you it's not really cherry pick. So this is the Monday CBDR. This is the mean, right? This is the place where price is just it's just stagnating like this, and we are not really coming into that deep of it. So it's really hard to use this right here, right now. But you see where price fell yesterday, and it fell so hard. It came into that 4, came into being so cheap that nobody really wanted to sell it anymore. People wanted to buy it because it's so cheap. So you could kind of say that you could find fair value gaps, you can find swing high, swing lows, but trading off of some of these points here is just can just really give you that roadmap that you're looking for. Look here, we're going to do the same again. We have the mean here, and then we have 1, 2.5. We go into it. Just look for it long here because price is now so cheap that nobody want to sell it no more. They want to buy it and they want to offload. Where do they offload? All of what they bought right in back at the mean of the CBDR. We do it again on the next one. See? So get that with overlapping a support or resistance or a fair value gap or swing high, swing low, whatever you like to trade. You'll be really set. If we dive into the lower time frame here, this is the day, this is today. We can then start doing the same. This is our swing high here to the swing low. Price is now so cheap here at the 4 that there's literally no reason to look for selling anymore. You see price kind of comes back. This is a very good example of seeing that it comes and swipe out liquidity here. And then price start pulling up again. Let's go to the next one here. From the swing low to swing high. 4 once again, right? You even see that 2.5 right here. You get a big reaction off of it because all of a sudden the people that bought down here or the algos that bought down here is seeing that this is a very good place to start getting rid of some of their inventory, if you can say. And this is like it doesn't matter what asset it is. It will work exactly the same. See here, way overextended. Start pulling up. If we go back to the first chart here, we see that we talked about this just before. Right here. Yeah, it's very noisy right now. Doesn't matter. I just wanted to show how it worked. So, does anybody have any questions for Baxter?